So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer the question, what's the point of trading high implied volatility when the stock is making even larger moves? So this question came from another one of our members, and the underlying theme here is really just this idea of why do we trade options when high implied volatility is present in the market? Doesn't high implied volatility then reflect that the stock is going to make this large move or this massive move? So why are we stepping in front of a freight train, for lack of a better term, and trying to trade options and sell premium, hoping that the stock is going to stay contained when everyone is betting on these big moves? And the reason that we do that is because what we've consistently seen, not only through our research, but you can also check other sources and other data providers, but when we see high implied volatility situations where a stock is expected to make a very, very large move. And we're talking the upper echelon of implied volatility ranges, the 70 to 100% IV rank or IV percentile ranges. When a stock is expected to have these wild moves, option premiums go through the roof. And so what we see that traders are expecting a big move, and therefore they bid up all option premiums on both sides, both calls and puts, looking for this big move. But the catch is that it generally doesn't happen as big as the market expected. Now, this doesn't mean that the stock won't move. In most cases, it probably will make a pretty big move. But even that big move is going to be more than compensated by the option premium that you might have been able to sell by selling strategies around where the stock is trading. So to use two examples of this, and you can check them out from just like recent charting here, GDX is a great example of this. Same thing with EWZ, which we're going through right now, actually, the time I'm recording this. GDX back in early August had a massive decline in price. And as a result, implied volatility went from basically the 20th percentile up to around the 88th percentile. Now, at that time, we sold a lot of option contracts in GDX because volatility shot up through the roof and had this huge movement. Option premiums were blowing up in the gold market. And so we sold a lot of options. Now, fast forward nearly 2 months, and GDX has, no joke, right now as I'm looking this on my chart, has moved dead sideways at the end of 2 months. Now, there's been some fluctuations back and forth, but the price that GDX was at when implied volatility was at 88 and the price that GDX is at now is the same price. And there's been a little bit of fluctuation between there, but basically what's happened is that GDX has really not moved anywhere over the last 2 months, although traders expected GDX to have a $3 or $4 move, but it's moved nowhere. And so that's the over expectation that we see all the time in pricing. Now, granted, this happens a lot with GDX and SMH and all these other ones. It doesn't happen all the time. I'm not here to say that it happens every single time, but the vast majority of time, you have a much better probability of success. The odds are heavily tilted in your favor to be selling premium during these time periods. The other example here is EWZ. So EWZ had recently gone through an election, and right before that election, option premiums were about $5 to trade a straddle. So even though the stock was trading at around 36, you could collect about a $5 premium for trading the at-the-money straddle. And so that basically would have put your break-even point around 41-ish, depending on where you traded it. Well, fast forward and we got the election news out of Brazil, and whatever the results were, and I honestly don't even know what the results were, but it caused the market to move. And the market had a big move. It was up almost $3.50. Now, most people were freaking out because this is a big move in EWZ. It gapped higher. It had a lot of volume, a lot of liquidity coming into the market, but it still wasn't enough to cover the difference in the option premium. So traders were expecting an even bigger move in EWZ. And although we got a big move, for sure, it was a big move for a small ETF stock like this. It was definitely not the big move that we expected. So again, the reason that we trade implied volatility when it's high, even though we're expecting large moves, is because the option premium should more than cover the expected move long term. And so if you stay small, stay consistent with these strategies, you're going to be on the winning end as an option seller and try to let everyone else try to expect and over anticipate where things are going to go in the future. As always, hopefully this helps out. If you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.